you want to follow up some questions, because I've got a lot to talk about. I may not get it all done. I'll do my best. If you have any questions on terminology or ideas, please let me know. So, basically what we saw was supposedly one of the worst economic upheavals since the Great Depression. So many people chose to call it the Great Recession. As it turns out, the economic conditions that preceded the Reagan administration, in many ways, were much worse than the current conditions. But in any case, it's become part of the sort of general lore and legend that this is the worst economic upheaval since the Great Depression. It's somewhat questionable, but in any case, it's serious. There's been a global financial meltdown. We saw a great deal, with the exception of India in part, and a few other countries like Sweden would suffer quite much. But so the question is, what happened? Now, this has been hashed over in the media quite a bit, just beyond the capacity to be repaid. And a lot of details in that we'll talk about in a moment. So these commercial banks found themselves either illiquid or insolvent as people began to either be unable to repay their debts or began to withdraw liquidity. We get a liquidity crisis. And it actually started, I was here in 2007, when the rumblings of this liquidity problem occurred. And instead of letting it work its way out of the system, central banks around the world jumped into the game, pumped in more liquidity, pumped up the bubble even larger than it was before until the bubble burst. So what we had, governments began to bail out the commercial banks. Then the commercial banks had to bail out the governments, as we see in Europe and Greece and so on. And the commercial banks had to be bailed out by the central banks. So all we've seen is this grand shuffling of paper. You get a green piece of paper, I get back a bond. Or I get back a bond that has longer term rather than shorter term. But all we've done is see pieces of paper being shuffled around and nothing fundamental really being fixed. And this has happened around the world. Now what did happen is that households and businesses, especially in the United States, began to deleverage. That is, they began shedding debt, trying to recuperate and their balance sheets. But governments at all levels in the United States, the state and municipal governments, the federal government, doubled down on borrowing. They went on a borrowing bin. So the problem was too much borrowing. Too much borrowing in particular by the private sector. The solution? Too much borrowing by the public sector. One has to wonder how. Even a 10-year-old child would see that that was nonsense. Anyway, so excessive borrowing was a curse in the hands of the private sector, but somehow, and of course that somehow has to do with something known as Keynesian economic theory. Keynesian economic theory gave credibility to public sector borrowing. Now, one of the motives for government involvement in the financial sector was that commercial banks, there were many commercial banks that were too big to fail. In other words, if these banks failed, there would be systemic crisis. That is, the whole system might melt down. Now, let's see what happened. Before 2008, assets of the 5 largest banks in the U.S. were 43% of U.S. GDP. Now, the top 5 banks have doubled the amount of assets, and it comes to about 56% of GDP. So, too big to fail was a problem. Now, it's an enormous problem. Instead of liquidating firms and letting them disseminate into the market in a different way, what we've seen is more and more concentration, and more, we've got more vulnerability now. If you saw in the paper yesterday that Morgan Stanley had a hiccup of $2 billion. They lost $2 billion, they don't know what happened. If they're reporting $2 billion, it's probably $20 billion. If the loss was $20 billion, leverage of $20 billion may be $200 billion. They're in big trouble. So now we got consolidated few mega banks in the United States in particular where we've got more vulnerability than before. Now let's see what the conventional understanding is. All the blame was put on either financial deregulation. The conventional story here was the deregulation of the financial sector, irresponsible regulators. This caused unbridled capitalism. Depending on what country you might live in France they call it savage capitalism or whatever neoliberalism. All of this. That all of a sudden the world in 2008 suddenly became a free market paradise where there was absolutely no controls over whatever businessmen or financiers wanted to do. That was the story. That was the explanation. Now, part of this was that there are a lot of new financial instruments that came up. The hedge funds, financial derivatives, the credit default swaps, special investment vehicles that allowed banks and financial institutions to put things off of their balance sheets so that they could leverage their borrowing and lending more. So this was a particular problem with this. Then there was a greed and dishonesty of private sector actors. The bankers, of course, were paying themselves bonuses that were outside, even if they had losses. Homeowners in the United States were dishonest about their ability to repay. They had what they called liar loans. Lie to the bankers, and they would go ahead and give you a loan. Or in fact, they wouldn't even ask the question. And then central bankers like Ben Bernanke of the United States said there was a global glut of savings. It was your fault. You Indians saved too much, and the Chinese, by the way. That is, this was creating excess liquidity that drove down interest rates that created this situation. Okay? So it was your fault. The responses, bailouts, banks in particular, AIG, big insurance company, subsidies, larger deficits, more government regulation, looser and looser, more expansive monetary policy, pump money into the system, keep it, stop deflation, stop the rot by having government spend more, and thus borrow more. So this is what happened. So all of this blame as it was devised led to these responses. And all of these were 180 degrees wrong in the sense that they have not solved the problem. They've made it worse. In the United States, we had a new banking regulation, legislation for banking that introduced 243 new rules, and regulators were given the ability to just invent new ones. Now, again, what this does is, if you know anything about economics or about operating a business, what this means is that it's going to be almost impossible for new financial players to come into the market. Why? Because the compliance cost of this new financial regulation is so high that the amount of capital you'll have, not capital, the amount of spending you'll have to have on just operating to hire the lawyers to understand the regulation, to be on top of, to hire lobbyists to hang around in Washington to find out what's going to happen. This is going to make sure that there's less and less competition in the industry. And most of us in this room, I would hope, believe that competition is a better thing. So let's look at this argument. Was there too little regulation in the financial sector? Well, in the United States, they have 39,000 full-time regulators. Their budget for all, and this is just a few of them, they increased by a factor of 15 over 50 years. So how much do we need? Do we need 100,000? Do we need 1 million? How many regulators do they need? The problem wasn't too much regulation, too little regulation, or too few regulators. It is the instinct for government regulations to regulate until it needs to be regulated some more. In other words, fix it until you break it. When it's broken, have new regulations to fix it again. So the U.S. banking sector is the most heavily regulated sector in the entire U.S. economy, as it turns out. Now, it is always the case that we know that regulators are always looking for more power and larger budgets. So, these regulation failures have nothing to do with George Bush per se. They don't have to do with the personalities in office or the baboons that are running the regulatory agency. It's all about the incentive structures. Regulations tend to fail because of the incentive structures that are given to the regulators. So, well-intended regulations lead to unintended consequences. These unintended consequences generally lead to, we see in this case, that small problems become larger ones. So tomorrow's crisis arises from solutions to yesterday's crisis. And I'm afraid there's a much bigger one looming in our future. Regulations aim to reduce financial risk, but they tend to increase the financial risk. And I'll explain why. Bailouts make it more, bailouts encourage risky behavior. If you get bailed out by the government, that means you don't pay the cost of making a mistake. You know that if you fail, they'll cover your losses. So bailouts, and we can see the mother of all bailouts, almost the beginning of a lot of this misbehavior in financial markets, can be traced back to the so-called tequila crisis, when the Mexican government had fixed its exchange rate to the dollar, was able to borrow lavishly on international markets. They were paying relatively high interest rates because it was an emerging market economy. Because of risk, they paid higher interest rates. Well, when they got into trouble by overborrowing, the U.S. government pressured the IMF to bail out the lenders. And where were the lenders based mostly? Goldman Sachs, Morgan Stanley, all the big players on Wall Street. So when the IMF stepped in to bail out Mexico, this sent a signal to countries around the world. Get into a mess, we'll fix it. This is what economists call moral hazard. You created rewards for bad behavior. And I would put it down to that. That's where we first saw the really large bailout begin. And then we see them cascade down. The problem in East Asia in 1997 has direct linkage to that, I believe. Now, let's see what happened. The U.S. housing bubble is seen by most people as the sort of trigger, the beginning of it. Now, let's see what happened. Most of us don't have, certainly you guys wouldn't have the background on this, but we can find in the years before 2008, the U.S. government, through legislation and through public declaration, put pressure on private banks to lower standards. Now, this takes a little bit of history. I shouldn't get into it too much, but back in the 1930s, there was a technique called redlining. The federal government would back mortgages with guarantees as long as people could repay them. Makes sense, right? You don't want to issue debt to people who can't repay them. It turned out that the federal government regulators would circle on a map with red lines saying, we will not support loans in these geographic areas, because the people in those geographic areas didn't have sufficient income to repay a loan. Now, it turns out historically, in the United States, most of the people in those red-lined areas happen to be, there were lower income people that happen to be African American and now more recently Hispanic. So instead of seeing this as an economic motivation, it's seen as racist. And it became a disgrace for banks to redline areas. So the government that invented this, government agencies invented this practice, began to punish banks and said, well, you have to loan to them. And it's your, so you have to lower the lending standards so that low-income borrowers can borrow. These are called those famous subprime mortgages. This led to more purchases, led to higher income, higher housing prices, which fueled this bubble. And we can find the beginning of it in U.S. government public policy. At the same time, there were government-sponsored enterprises. These were agencies that would deal in mortgages. They would buy mortgages from banks. They would use money that they borrowed on global capital markets at artificially low interest rates because they were backed by the government. So this wasn't a market-based activity. This was a government-sponsored activity. So they kept buying all these bonds, reissuing them, and selling mortgage-backed securities that became the so-called toxic assets that German banks were holding, banks all over the world were buying up, other private banks were buying it. This was driven by U.S. government policy, public policy. So what we see then is the politics and financial power of the housing lobby led to operations that were beyond the norms of fiscal discipline. So they weren't following basic economic principles, or financial principles, with implicit government guarantees, so that the market didn't limit the size of these guys. They became big, enormous. They hold over $1 trillion in mortgages. That would never have occurred if they were a market-based entity. People kept lending them money at lower rates of interest because they said the U.S. government will bail them out. So these guys became too big to fail. Now, just raising interest rates would stop all this nonsense. In 2007 was the beginning signals of a liquidity crisis. I was actually here, and I published an article on this. And the New York Times called me up from somewhere and interviewed me on it. I said, what the central banks are doing by pumping liquidity back into the system is criminally stupid. That is, they're just going to make matters worse. And of course, it went on for another year before it collapsed anyway. But not only the U.S. central bank, but virtually every central bank in the world followed suit with pumping liquidity. So there were no market-based restraints on credit creation, and financial systems just kept getting, financial players just kept getting bigger and bigger. So what my message is going to be here is that monetary central planning, that is central monetary policy executed by central banks, in the sense of its central planning in that they're creating crises and directing the economy the way central planners do. They were the basis of the crisis that we saw. So let's look at what we can call fundamental and proximate causes. Now, proximate cause is the most obvious cause of any event. So, government policy and incompetent regulation led to the misbehavior of bankers and home buyers. So, I told you these policies that said, push people into houses. Do whatever you can to get low-income people, as many as possible, into houses. George Bush had this sort of, I forget what it was. It was a special program to get as many Americans into a house. Never mind they can't afford to pay for it, just get them in. So the Bush administration, the Carter administration, all the administrations preceded were doing the same thing. But this wasn't a matter of politics or political party.
So you think about the community reinvestment act?
Bush had this sort of homeowners plan, to get this terminology. Now, so we had lax lending standard due to political pressure, a failure of a cartel of rating agency. The rating agency were asleep at the switch. They were not saying all of this debt accumulation is going to be problematic. Now, so they were set up in a situation where they had basically a cartel. Only 3 large rating agencies were certified by the U.S. government to oversee this process. And they wanted as much banking business as possible, so they didn't give banks a low-grade rating. They tended to cooperate. So, Then we have the implicit guarantee of taxpayer bailout of Fannie and Freddie that allowed them to get too big to fail, as I mentioned a moment ago. But the fundamental cause, the cause that if this didn't occur, none of this would have mattered. So these were bad enough, but without monetary and credit policy, well, I should say, sorry, loose monetary and credit policy, what was happening is that the central bank was driving interest rates down further and further and further below market interest rates. So if the market interest rate would be, say, 4 or 5%, they were holding interest rates for a time. It was laughable at 1%. Now interest rates are 0.25% in the United States. I tell people this story that if, when I was a graduate student studying economics, that I said, you know, I had a dream about the future in America. One day, the Federal Reserve would hold interest rates below 1% for a very long period of time. Do you think that's a good idea? They would have tied me up and thrown me into a room with a padded cell. They would have said, you're crazy. Nobody would do that. That would destroy the economy. Now, something that I would have been thrown out of graduate school for being so stupid to ask a question. But today, intelligent, well-paid central bankers tell us it's a good policy. Something that would, anyone in their right mind would say that will destroy the economy. And what we've seen is that money is the root of all evil. In the sense that money created by central banks under the guise of cheap credit policy create almost all the problems or set into motion. Now, remember those arcane financial instruments, the derivatives, the collateralized debt obligations and all those things? Why didn't they occur? Why did someone come up with them 20 years ago? Why was it that bankers only all of a sudden became greedy a few years ago? Haven't they always been greedy? They've always been greedy. What happened is that they were allowed to do those things because the markets were flooded with liquidity. If you're a banker, the way you make money, the way you stay in business, is push that money out the door. Because if it's on your deposit, you've got to pay it back with interest. And you're in business to make loans, so you've got to make as many loans as possible. So you go to the potential homeowner and say, we'll make you a deal. We'll give you a mortgage, whatever terms we need to get that money out the door and get you into a house. And we're going to sell the risk to someone else, so we don't care. Fannie Mae and Freddie Mac will buy it, and they'll sell it to the Germans. So we don't care. Now, none of that would happen if there wasn't so much liquidity. And the homeowners are going, the interest rates they're never going to get this low again. If I don't take this opportunity, I'll never get a house. So my argument is, bankers were not villains, they were victimized by the conditions of excessive liquidity. They were forced, with all this liquidity coming into their banks, they had to get it out the door. And then, by the way, while they were doing it, profits looking very good, so they paid themselves huge bonuses. So the idea that somehow bankers just instantaneously, became greedy, they've always been greedy, but they couldn't get away with it. There weren't the kind of pressures on them to do what they were doing. So they kept rewarding themselves because, the markets were booming. Why wouldn't you pay yourself more? You could afford it. None of these things would have occurred if central bankers had not been so irresponsible. I would say criminally irresponsible. Alan Greenspan and Ben Bernanke have destroyed more wealth than Genghis Khan, Attila the Hun, Tamerlane, name any historical villain. These guys have been on a rampage with their monetary policy. Now, the rest of the central bankers in the world went along for the ride. The United States was particularly egregious in this misbehavior, but all the other central banks went along with it. Artificially cheap credit, conjured up by central bankers, undermine the idea of risk. I mean, with interest rates so low, that meant that government debt sells at a very carries a very low interest rate. So when people are trying to buy risk-free debt, they're getting nothing. So they start looking for riskier ventures. So again, they push people into riskier ventures to do things that they wouldn't have done, perhaps, without that excess liquidity. Now, as it turns out, this is an old story. Government policies are behind every recession. That is, every recession that lasts for very long. Now, markets might throw off some amount of, if we put time here and we put, say, GDP growth here, we might see something like this. Okay, in a free market without government interference. But what we see in the real world with government involvement is something radically different. What we see is a Great Depression and now a Great Recession. Now, why is that? Now, markets are always made up. Markets exist because different people on different sides of a trade have different values. The only reason you would trade this for that is that I value it this less than what I value that, and likewise you. So we trade. So on the opposite side of every transaction are people with different values. Now, these things that we call bubbles are situations where, for some reason, everybody seems to be looking for a long position in the market. That is, everybody wants to be a buyer. Because normally there's a buyer and a seller. Sometimes we call them bulls and bears. The bull is holding a long position. The bear wants to take a short position. And markets tend to stabilize because tends to be a balance of bulls and bears. Okay? But when we have these asset bubbles, like in the housing market, or perhaps the Indian housing market today, I think is in a serious bubble. It's because most people are wanting to hold a long position. Now, why do they do that? Well, there's some misinformation out there encouraging everybody to make the wrong decision for a long period of time. Now, in the U.S. case, it was interest rates. Interest rates were simply low for too long. And interest rates are the single most important price in every economy. The single most important price. And it tells you what it costs to borrow, it gives you an estimator of risk and so on. But when you interfere with that, then this sends out signals that distort market decisions. So, whereas many people, the analysts of this Great Recession, saw this as the failure of the free market, the failure of economic rationality and so on. My interpretation is government failure. In particular, in as much as governments play a role in either the operation or of the creation of a central bank. That's the most important part. It's central banks that play the most important role. Then, on top of that, we have the problem with regulation and fiscal spending. So, there are a number of what we call moral hazards. In other words, these are incentives for people to do the wrong thing. So, guaranteed bank deposits, for example. In the United States, you can put up to $100,000 in a bank account. If the bank goes bust, you get every penny back. You got more than $100,000, you just open up another account in the same bank. And they'll cover that. So there's, in effect, no limit to it. So what this does is that the depositors don't worry about risk. They don't care what the bankers do with the money. Because the government's going to give it back. The bank closes, they'll get their money back. So depositors take risks. The bankers take risks and say, well, again, if we go long, the government will bail us out. So this is a moral hazard. Everybody, the depositors are not worried about their irresponsibility factor. The bankers aren't worried about their own risk behavior. So in the end, we have a socialization of losses, while the gains remain private. So this is the worst possibility. Artificially low interest rates, I mentioned it, encourage risk-taking. Central banks, with their monopoly of the money supply, that they oversee a cartel of private banks that are basically, central banks exist for two purposes. Principally, central banks were invented to finance war and imperialism. That's why they're invented. Today, they exist to finance government deficits. Almost all the new U.S. government debt is bought by the U.S. Central Bank. Much of Greece's new debt was bought by the European Central Bank. This is what central banks tend to do. Now, the other thing that central banks do is keep bankers rich. That is, if the interest rates are less than 1%, bankers can borrow money at an almost zero interest rate and lend it to you. Or what they do is that a foreign bank could come to America and borrow at U.S. interest rates and come and lend it here in India at a much higher interest rate and keep the spread. So these are great opportunities for private banks to enrich themselves at our expense. So there's no natural checks on credit expansion posed by a competitive market. And there's also no restraint based on a commodity standard. For the first time in history, we have no country in the world that has a limit on the amount of money it can issue based upon a commodity standard. Going back to 1971, when the U.S. moved off of the gold standard, it was the end of any restraints on central banks being able to issue any amount of money they wanted. That was a critical change. So now we have an infinitely elastic supply of money. That is, it can expand to infinity, which is a recipe for eventually hyperinflation or economic collapse. So we're in a real dangerous situation because central bankers believe they got a control over things. They don't. These idiots in America. You know what's happened to the value of the dollar since the central bank took over in the United States? It's been devalued grotesquely, where a 10-cent silver coin, 2 of them will buy a gallon of petrol. That's how much, just since the 1970s, the value of the dollar has collapsed. So, they don't have control over anything. And they don't know where we're going because they don't know how we got here. Alan Greenspan, the head of the U.S. Central Bank, said, there's no housing bubble in America. There's a little bit of this and that here and there, but there's no systemic housing bubble. They can't understand that central banks play a role in creating asset bubbles or commodity bubbles. It's not in their model. What do central bankers look at? Your central bank looks at wholesale price index. Only country in the world that happens. That's what they consider the indicator of whether they're doing the right thing or not. In the U.S., they look at the consumer price index. If it's stable, they say, oh, we're doing the right thing. Never mind that commodity prices are all over the map. That bubbles are forming everywhere. We didn't do that. That's herd instincts. That's irrational exuberance. That's bull. That's nonsense. No, it's caused by excess liquidity from all this artificially cheap credit and the lack of any kind of restraint on expansion of money supply. So, what we see then is that central banks manipulating the money supply, playing central planner. They're just like the central planners that failed in the Soviet Union. They're trying to create a sort of imaginary world where they control the money supply and the rate of the rate of increase in the price indices and by jiggling around the interest rates. You know, most people, even non-economists, understand that fixing prices, so if you fix the price of potato, you fix the price of paddy or pulses, you know it's going to go wrong. It'll lead, if you put a price ceiling on it, you're going to have shortages. Everybody knows that price fixing causes imbalances that don't go away. But somehow central bankers are given a pass when they set interest rates. It's just like price fixing. It doesn't cause shortages in the same way, but it causes imbalances. And those imbalances are usually, in this case, bubbles. Now, these government policies can be summarized in what I call Lingle's Law, where government interventions lead to an endless loop of imbalances that create a demand for more intervention. So we have something like this. We have a government intervention could be holding down interest rates, causing a market distortion, say housing bubble. This disequilibrium affects special interest groups, and then they demand some form of government intervention. Bail out the banks. That creates another market distortion. That affects another group, and so on. So it just goes on, this endless cycle. So new government regulation is needed to fix the bad effects of old government regulation. And this is, again, something of an old story. Now let's look at some conclusions here. Higher government borrowing and artificially low interest rates are the wrong remedy. Those are the things that got us into the problem. It was high private sector borrowing. But how is it that higher government borrowing can be the solution when excessive... Greece cannot... What are they going to sell? They sell sunshine to tourists and olive oil and a few ships. What are they going to sell? They can't repay that debt. It's too much borrowing. And why do they borrow? To hire more babus. Everybody works for the government. You work for the government, you can retire at 50. You shouldn't go to Greece. I could retire years ago. Women retire at 50, men at 55. Why women live long. It seems like you should go the other one. Women don't like that. So, now, what does an asset bubble mean? An asset bubble means that prices have been overshooting. That is, prices have been at an unsustainable level. So if they're at an unsustainable level, what should happen? Prices should fall. Right? I mean, you tell this to a child and say, well, if you're up in the air too high, and that's a problem, then the child will say, well, then you need to get closer to Earth. And the child would understand the basic logic of that. Oh, not central bankers. No, that's deflation. That's unambiguously bad. So you have to stop it. So the U.S. government had been in the business of stopping these overstated asset prices from settling down. They did the same with the U.S. stock market. The U.S. stock market has a great deal of excessive price built in, again, because of all this cheap credit just available there. And some of it finds its way here to places like India, where you have NRIs that invest in different vehicles as a way of investing here. So historically cheap credit back in the 2000s led to these imbalances from excessive private spending and heavy debt burden. The policy response, more spending by government, meaning more debt, larger fiscal deficits, heavier government debt burden, and hysterically cheap. We went from historically cheap credit to hysterically cheap credit. It's unbelievable. They would have locked me up for being completely witless if I had proposed this when I was studying for my doctorate degree. Complete. Now, so what we had was a credit expansion that led to a boom that set up the bust. So the blame then is here. If you take that away, it wouldn't have happened. You wouldn't have had that overshoot in the housing market. Or go back to the dot-com. The dot-com bubble was the same thing. It was too much money, too much liquidity, too much cheap credit. Expansionary monetary policy cannot end a recession because it prevents the necessary price reduction. You've got to liquidate those overvalued assets, overvalued capital. Could be in machinery or in buildings or in businesses. They have to be liquidated. So the end result of trying to spend your way out of recession or to drive interest rates down, it's going to make it more severe and longer. So what we've had over the last 3-4 years is an illusion of all this paper shuffling. You get the green paper, I get the blue paper. You get the long-term bond, I get the short-term bond. Or you get a haircut. Crazy. Deficit spending to boost aggregate demand, crowds out private investment. What's happened? Now go and listen to all the central banks. Ask them, sir, why do you lower interest rates? Oh, because we want more private investment to boost aggregate demand so the economy will grow more rapidly. See, now you go to the U.S. and say, okay, what's happened to private investment in the United States? Silence. Banks aren't lending to them. Why not? Now, if you're a banker and you want to loan it to a private individual, you've got to hire some bank managers to look into credit worthiness, to accompany find the collateral, and so on. Well, it's time-consuming and it's costly, right? And it's risky because value judgments are made and so on. Now, if you buy government debt, you don't have to hire anybody. The bank just goes and buys government debt from Morgan Stanley or Goldman Sachs. You buy it first and sell it to them at a higher rate. Okay? So, risk-free. Right? So this is what banks are doing. And, by the way, in the U.S. case, they're paying the central banks not to loan the money. They're paying them a high enough rate of interest to make it attractive for banks just to sit on their excess reserves. So there's an enormous bundle of potential spending power that's being temporarily suppressed in the banks, which is terrifying. Because if in fact banks began to lend the money out, there would be an explosion in prices. Because there's just that much liquidity being held back. So in the end, we're not having any of this. This is why this recovery in the United States, we were supposed to, within weeks after Obama was elected president, they announced the recession was over. I mean, it had nothing to do with him, per se. There was no claim to that, but the recession is supposed to have been over for years. But in fact, there has been very little total recovery in terms of getting the U.S. back on its long-term trajectory. More regulations is going to lead to more distortion, more greater costs, and slower economic growth. The global consequences of this have been commodity and asset bubbles. Now, it looks great. You go to Argentina. They're selling everything they can to the Chinese. Soybeans, edible oils, they're going crazy. So the macroeconomic data for Argentina looks great. But then you go down to downtown Buenos Aires. Why is that business closed? Why is that factory closed? At the micro level, it sucks. Not much is happening. So we get this distorted idea because of these asset bubbles or commodity bubbles, like in soybeans, that make, which is, by the way, very few people in an economy are employed in the international sector, much less producing these commodities. So the macroeconomic data looks better, but the microeconomic data isn't so cheery. I had the same thing. I went to Australia last year. The Australian dollar's getting stronger. The macroeconomic data looks great. Same problem in Sydney. Why is your shop closed? That one's closed too. There's nobody buying these things. At the micro level, things were not looking so good. I will talk about carry trade if you want to know about that. So my conclusion on this is that this was not a failure of capitalism in markets. There was a great deal of these accusations were that, see, finally, this is the end result of capitalism. This is what capitalism does. It collapses on its own. Capitalism is unstable. Markets are unstable. So, now, this is a very appealing argument for politicians. I didn't cause it. They don't want to take the blame, if they understand it. Central bankers, I didn't do anything about the asset bubble. I was just looking at the consumer price index. So somebody else had to do it. It was capitalism. It was the markets. We didn't do it. So, you all know that the fine art of politics is taking credit and shifting blame. And so the markets are a very convenient scapegoat because most people don't understand much economics, and they fall for that argument. So, as I mentioned before, legislation has a big impact. Regulatory failures that are predictable, and monetary policy. So it's not that money is the root of all evil. Monetary policy is the root of all economic evil, in my view. That ultimately all the serious imbalances in any economy can be traced back to monetary policy. I read with great regularity and with great humor the publications from the Federal Reserve of the United States, the central bank. And they will pose a question, like, do artificially low interest rates cause asset bubble? And every time, no! We didn't do it. They hire these really intelligent, well-paid economists to explain why they're not at fault for anything. And it just goes down the list. I mean, I get a new study every week. Extensive research reports on this. And it makes me chuckle. Because they are able to manipulate the data, massage it around, to convince themselves that they are not at fault. So, the summary: recessions arise from government failure. Serious ones. Now, in the United States in the 1920s, there was a very serious recession. But the Federal Reserve was not around. The response of government was pretty much, whoops, let's see what happens. And the recovery was less than 18 months. We had a very sharp decline and then a recovery. Now, the Great Depression, the government tried to raise taxes. Does that sound familiar? They tried to stop trade. Everybody tried to allow their currency to be devalued. And it went on for 10 years or more. And you know what saved the U.S. economy from the Great Depression? Now, some people have tried the idiotic idea that the World War II ended the Great Depression. Now, if that's true, why do we have a World War today? Let's get this thing fixed. We'll fix it today. Now, who in here believes that a war really adds to economic prosperity? That is breathtaking in its stupidity. But this is the conventional wisdom. If you read most historians, most economic historians, they will say it was the war that did it. I mean, this is breathtaking. If wars are so good, let's have one. If murdering people, blowing up stuff, destroying wealth is good for economic growth, well, that's easy. Let's do it. But nobody really, if you begin to think about it, you couldn't believe that. So, you know what's ended the Great Depression in the United States? The fact that the war ended. And literally within a year and a half, the U.S. government spending went down by 2/3. They released all the slaves, conscripted soldiers, who had been enslaved, and many people were enslaved in jobs with wages that were held artificially low, and they had rationed food and all. That sounded like a great idea, right? How did this idea ever get past the smell test? Okay, once the government spending was cut so substantially, the U.S. economy took off like a rocket after World War II. That's what ended the Depression. Not government spending, not blowing up bombs and tanks and killing people and enslaving people.
Lou Rockwell points out that the Second World War reduced unemployment numbers by sending people abroad.
So unemployment fell because you either become a slave in the military or you died or both. So we talked about this idea of moral hazard, monopoly privileges granted to central banks with no natural checks on credit expansion, manipulating the money supply and interest rates to cheapen or ease credit. They cause a boom that sets up the conditions for the bust. So this is where we have to see the logic of this. The fundamental cause has to be traced back to excess liquidity. Now, how is it that the Chinese were able to save so much? Let's go back to that question. The global glut of savings that the Chinese or the Indians were saving too much. Where did the Chinese get the money to save? Well, by selling things to America. Right? They couldn't increase their saving unless they had higher income. How did China's income go up? Because they were selling more exports. Now, how is it that Americans could buy more from the Chinese? Because they were more productive? Because there was so much liquidity. Interest rates were artificially low. So the money that was being saved by the Chinese and maybe in part by the Indians, the increase, was because the Americans were printing too many green pieces of paper. Again, so it's how you interpret it. Ben Bernanke said, it's the Chinese and the Indians. And I say, no, it's you, stupid. You opened up the floodgate on releasing liquidity. How do you think they got the money to save? I mean, this is breathtaking that anybody who had any sense would believe that. So, but again, it's a way of shifting blame. Lingle's law, I mentioned, is part of the problem here with regulation. Fundamentally, it's a monetary pumping of liquidity, money into the system, and the extensive distortions and imbalances that set that boom and bust cycle. So, von Mises summed this up very clearly. It's not really Lingle's law. Other people said it better. I made it in a much more concise term. But the very failure of interventionism reinforces most people, the people that don't know economics, believe that private property must be controlled severely. The corruption of regulatory bodies doesn't shake blind confidence in the infallibility and perfection of the state. It merely fills it with moral aversion to entrepreneurs and capitalists. And we see this. This is what caused people to say the Great Recession was a failure of markets. And likewise, the Great Depression was seen as a market failure. And if government must stand in and must fix it. But you know, all those people that suggest that that's the remedy, none of them anticipated the Great Recession. I began writing about it in 1997, when Greenspan panicked after the problems in East Asia and flooded the global markets with liquidity. Because he didn't trust capital markets to be responsive to this. And I think that was because of Bob Rubin of Goldman Sachs, who saw this as an opportunity to hijack U.S. monetary policy. But many of my friends who had this same understanding I do, one guy, in fact, predicted the exact year based on the property market. Now, who would you trust? Someone who anticipated this problem or someone who kept saying, there's no housing bubble? Monetary policy is not overreaching. Who would you trust to come up with a remedy to fix it? Somebody who saw it coming or somebody who was kind of hanging around when it was happening? But unfortunately, the guys who were hanging around when it was happening are the ones proposing the remedy. The Paul Krugmans of the world, the the politicians of the world that see this as an opportunity to expand their access to your resources and to limit your freedom of action, which is what is the outcome. Okay, that's not much time, but I'm happy to entertain questions.
Thanks, Chris.
Linked with that is the question, why is it without more crisis? You explained how it's industry. But as far as Bernanke's argument goes, think about it this way. In China, we have two giants. They kept the prices artificially low. So what was actually happening was Chinese were recycling their money into ahead. So in the form of treasury bonds that made like really low interest for the safe. Like you said, government bonds are safe. Now, liquidity excess was the problem again. But how was it that this excess suddenly becomes a problem? Like historically, the first instance of liquidity increase was in 1971. If you see the graph from 1970 to 1975, that was the biggest ever increase in liquidity. So what suddenly happens in 1980s or 1990s that this entire thing, like for instance, how is it that the regulatory framework begins to weaken so much, like you said, that it fails the stiff test?
Yeah, I think, in part, I think what happens is that the generation that was overseeing monetary policy in the 1970s, when the gold standard was abandoned, had lived with the gold standard. And they had in their mind this sort of sense of discipline built into their thinking. And then the subsequent officials and politicians, well, that came in, lost any kind of sense of those anchors, those historical. And these are somewhat even psychological. Sort of like, it's just something you don't do. Like I say, it was unthinkable in the 70s that the interest rates would be this low. Nobody would even consider it. I said, no, but really, let's think about what would happen. No, they wouldn't even talk about it. They say, the long-term cost of capital in the United States and most developed economies is at least 3%. You only do less than 1%. That's crazy. You've got negative real interest rates. It's bizarre. They wouldn't even count that. Consider it for them. So I think part of it may be that we have this sort of evolution of policy making. And then I think over time, the politicians have become less and less responsible. Because they sense that there's no anchor. For them, there's no restriction on how much they can borrow. Because the central banks, if they just push interest rates down, it keeps the interest rate burden on their debt low. This is why interest rates aren't going up in debt. Every country in the world that's borrowing money, every government in the world, is doing it at ridiculously low interest rates, or historically low interest rates, most interest rates. And in the United States, if the interest rate went up to 3%, the interest charges on the new debt would just explode. They'd have to shut down entire departments of government, which may be a good thing. But so they've got a tiger by the tail now. And what was happening, I think, initially people, they were playing with the tiger and it seemed like fun. They just didn't realize that they were letting it. The tiger was getting big. It was a little baby when it started. And they were playing with it. Now it's a full-grown tiger. No, there's really no good way out of the current situation. Everybody has become greedy. Governments around the world have painted themselves into the corner. There's virtually no way out except default or economic collapse. Huh? Well, I mean, go ask your banker why defaults are bad thing. But what you've done is basically take somebody else's wealth away from them. Let's say that if Greece defaults, and I'm a German bank, and my depositors are pensioners, my depositors are hard workers, and all of a sudden I say, sorry, I'm not going to pay you back because we've got to forgive Greece for the fact that they hired too many civil servants and gave too many generous pensions to them. Yeah. They're not going to lose their pensions, but you're going to get them. That's why it's a bad thing.
What stopped the German banks from applying the Smith test and finding out that
Yeah.
Why should
Well,
they not be punished for
the
that?
thing was that they knew that the Greeks would be bailed out. They were part of the euro. The problem was Greece
Did they have a choice?
got artificially low interest rates.
No, when you're in a political economic situation, you don't really have to.
No, of course, the bank always has a choice whether to get.
Oh yeah, you choose it, but he sees very clearly that they'll be repaid.
No, I'm just saying, like, if the loan has gone bad, right? Now, if the one lending had all the resources in the world, could hire the best agencies, and that's another question I'll ask you. Like, if they could have all the resources themselves, they're big enough to find out whether this will be or not. And if they relied simply on the moral hazard that you raised, whether this will be paid out or not. And then today, if Greece says, sorry, bad luck, we won't know.
Well,
and Argentina's done it once.
It's just in a way, it's just like a bubble. You're in the middle of it, and you don't see the end. And what was happening is the German bank was saying, gosh, Greece is paying a higher interest rate. And it's a government loan, so it's going to be repaid against taxes or whatever. As long as the Greek economy doesn't totally collapse, we'll get our money back. And it's the best possibility for our shareholders under those terms. And so you're sort of seduced into it, just like you're seduced into buying an overvalued house by the fact that housing prices have been going up. So you're right. The problem is the bankers were reacting to false signals that were no fault of their own. And those signals were, interest rates, moral hazard issues, and so on. And in fact, what we saw too is that governments were pressuring the commercial banks to buy government debt, other governments' debt as well, in this recent round. So now, we're a year later, and people pretended for a year that this problem in Greece was solved. And now today, the problem in Greece, every day if the stock market goes down, because people are unsettled about Greece. Well, I was unsettled about Greece a year ago. I knew nothing would change, nothing fundamental. They're not fixing anything problem. They're literally papering over the problem. With longer-term bonds instead of short-term bonds. With, swapping new, freshly printed euros for freshly printed government paper. So it's all got to go wrong. I can't see a happy ending to this story. Because that tiger of government debt, the bubble of government debt, is going to devour us. And the euro is going to collapse. I was convinced, I know a lot of these, I lived in Luxembourg, so I know personally a lot of the people involved. Jean-Claude Juncker, these high-level bureaucrats, politicians. And they are willing to destroy their entire economy for the sake of their political experiments. But I don't think that they can do it. I don't think they can save it. I used to think that I said, the euro will hold at any cost because it's their baby. They've invested so much emotion into this political project that has no economic basis, no economic rationale. But it looks like it's going to come proper now. Because even they have talked about it. Even now they see that cost is just going to be too high. Especially with the Germans facing new elections. And Angela Merkel is not going to want to say, I have to impoverish you to bail out the Greeks. And the Greeks are saying, the hell with the Germans. That's not good public relations. They're portraying the Germans as the villains. The Germans saying, hang on, you want me to lend you money and you don't want me to have conditions on how you spend the money? What kind of stupidity is that? They said, yeah, but we want things to stay as they were. Well, we can't.
As a sovereign country, if you and I were entering into a contract, you were willing to lend me money, and I just said that these are the rules, take it or leave it. Why is that something necessary?
That's the way the Greeks are reacting.
Yeah, why is it necessary?
It's not.
So, once they've landed into this, being a free country, why can they not decide which course to follow? I mean, as an economist, you may say this is better or not, but as a politician, you must still have the right to decide which course to follow. Well, think of America after the Second World War. They simply refused to be the lender of last resort to suit their domestic interests because universal franchise had been used. And that's one of the reasons why the gold standard had collapsed, because Britain was not in a position to do that. So, why is looking internally, taking care of the jobs of your worker, necessarily a bad thing?
Well,
because once you
okay, but don't ask me to bail you out without condition. Because what you've seen is a degree politicians of all political scholars have been grotesquely irresponsible. They've lied about their books.
But they knew they were lying forever.
Well, the politicians do. The politicians do. The politicians.
And the Germans had and moved up their books when the euro was declining.
Exactly. They all wanted them in. So, but there was a politician. It wasn't the market. The market said, "What's in it for us?" And the government said, "Well, we'll fix it." So again, I think people in the market were victimized by irresponsible politicians on all sides. So I just can't see. I just say, okay, Cris, you don't want our conditions, you're on your own. Make your decision, look after your voters, but it's your problem. What's wrong with that?
Yeah, no problem.
That's a better solution, in my view. Because especially in the case of Cris, they are grotesquely irresponsible. Those guys, they got nothing to sell. What are they going to... They refuse to privatize any state-owned industries because they know that they would have to shed labor.